All right, so let's go and I'm going to share a different screen here. And there we go. Okay. All right. I assume you are looking at the SunGard Yarp portfolio screen. Like I said, I'm going to be doing something with Seeking Alpha pretty soon, so got some new slides in order. It's interesting. This thing is called, what's the secret sauce of dividend investing? Okay, so two thoughts immediately came to mind. There's no secret sauce, except for the McDonald's one on the left here, and uh, Fast Times at Ridgemont High. For those of you who remember the movie, what's the secret sauce of Bronco Burger? What's the secret sauce at All American Burger? One of the probably best cult films of the 1980s for people my age. But it did remind me, you got to create your own secret sauce. Everybody should really be doing it separately. And one of the things that questions I guess I get constantly, why can't I just buy the S&P or a bunch of high yield stocks and funds and make money all the time and over time? Oh, if I have enough time in the market and all that. Not saying that won't work out, but I'm saying that we've just gone through probably the best time period in our lives for that working out. And it's kind of like saying, hey, this NBA player has just made 10 shots in a row. Well, he might make 10 more in a row, but he's bound to miss at some point and maybe go cold. Okay. So, markets go hot and cold, markets are cyclical, just like strategies are. It is usually right at the point where people believe that something is infallible. Wall Street history calls this a one-way trade. You only have to buy it and you never have to sell it. So again, I'm not about predicting the future, and I'm not telling anyone what they should do. Okay, that was my old job. I was an advisor for 27 years. My job is to explain what I do, how I do it, and then you can decide for yourself, which parts of my approach, if any, matter to you. That's why this is a research service, but we go an extra step in this investing group and really try to make it a group, which especially we'll be doing in a couple of weeks when we close the sessions, most of the sessions, but for maybe one a month, to paying subscribers. We've been at it 3 months tomorrow, so happy 3-month anniversary to SunGard Yarp portfolio and Seeking Alpha. So I look at it this way: it's kind of like a Jenga game. All right, what's going on right now? There's a lot of stuff that people have gotten away with for a while with their money, leverage and meme stocks and options that expire today that just came to market today. Zero DT options. Yeah, it's great while it lasts, but just don't go forward expecting past to be prologue and be happy if it is. I updated this chart, so I wanted to show it to you. Probably update it again because the session I'm doing for Seeking Alpha is not for about 4 weeks from now. So I love to use this equal weighted ETF, this EQAL. It's the 1,000 largest, so S&P 500 plus 500 more, and they're equally weighted. So this really is like the average stock. It doesn't have really small caps, but it's definitely got plenty of kind of mid caps and all the large caps. So, I mean, here we are. This is a period of over 3 years now. In fact, that's 37 months. Okay. So in the last 37 months, the S&P is up 32%. I would venture to guess that if I said to people in the last 3 years, how much is the market up in total, including dividends? People would probably say 50%, 60%, maybe 100%. I don't think they'd say 32. And the reason is because it's easy to forget about 2022 when you've just had a 2023 and a 2024 that were almost straight up, especially from here. So when you look at the rest of the market, and let's face it, I devote most of my time to either stocks that pay income or dividends, or stocks that I feel like I can put an option strategy around, control my risk. The fact is dividend investing is getting tougher and tougher and tougher. So, I am looking beyond just the biggest names in the S&P 500, the handful of names that I'll show you in a minute that have driven the returns. So if you look at the average, okay, so this is the S&P 500. Remember, you've got, some stocks that have 6-7% weightings in there, 3 of them, in fact, okay? 3 stocks make up 20% of the whole index. And in the last 37 months, okay, you've made almost 1% a month. Not bad, not bad. And but if you look beyond that and then you equally weight them, so the big companies don't stand out, you are clicking along here at about 0.3% a month. So about 4% a year, not even, because this is 3 years and a month. So you're talking 3.5% compounded. Okay. So how's the stock market doing lately? It depends which market you're looking at. And I think one of the biggest risks to the market going forward is that this is where everybody's money is. And don't even get me started on NVIDIA, phenomenal company, but there's 100 different ways to participate in NVIDIA, a lot of them with leverage. It's bound to be a problem. If it isn't, great. But I look for where risk could be, not predicting where, what's going to go up or down. It's all about really putting if you will, the odds on everything. Okay. So, following up on that, going back a little bit further, I saw somebody mention this, probably on X or something. So, I thought, okay, let me do my own research on this. So this is really from the beginning of the pandemic, just about. So the market topped in 2020 before the pandemic, 19 days later, February 19th. So, and of course, recovered very sharply. So this is a 5-year return. In dollars, this is the SPY, so 1/10 of the S&P 500, this is the ETF. SPY has gained $282 a share in price. These 8 stocks are 158 of the 282. Okay? These 8 stocks. You know them, you love them, and you might have forgotten about Broadcom because it's kind of like the 8th Mag 7 stock. Okay? So that means 8 stocks have produced 56% of the total gain over 5 years, with 2022, which was a pretty rough year, stocks and bonds, and early 2020, where the market fell 33% in 5 weeks, only to recover sharply when we realized we were going to be able to see each other again in person. So 56% from 8 stocks, 492 only contributed 44% of the total. The bad news is it's a very deceiving market. The good news is that there's a lot of stocks in this environment that it's going to take a while, I suspect, because the broad market could end up being rough or at least just volatile, go nowhere for a while. But there are a lot of companies that are finally, after 5 years of this, or 3 years of this in more cases, a lot of really good companies that have become more reasonably valued. At the same time, lessons of every market cycle that I've seen is you could buy something that's cheap and it can get 30% cheaper like that. Why? Because the market goes up and down all at once. Think about if the open this morning here on Monday, February 3rd, a pretty rough open. It was pretty rough overnight. And, all the talk of tariffs and impact, et cetera. And it's settled down, but, it's one day and may not be over. So, you have to look at that and say, all right, it's a treacherous environment. And everybody has to kind of decide how bold they want to be. So now I'm going to cover in just a few minutes here the whole idea of investment process, because to me, we could talk every week as we do as a subscriber group here. We can talk every week about, oh, what am I looking at? What are you looking at? What's what looks good in the charts? What do you think is going to happen with GDP and the Fed, et cetera? Okay, we can wax poetic about all that, but that's the last part. That's like the fifth part on the ladder. Okay. It starts with philosophy. What is philosophy? What do you want to get out of this? And what are you willing to do and to not do? The second part is process. Well, how are you going to go about doing that? The third is strategy. Once you have these two set, you come up with a strategy to try to deliver on the process and the philosophy. My strategy is, and my process and my philosophy, but really more the strategy and the process. That's what Sun Garden Yark portfolio is. That's why people sign up. And it's also probably in most cases why people don't sign up, or I'm not afraid to say, shouldn't sign up. Because if you believe completely differently than I do when it comes to philosophy, process, and strategy, then, it's maybe a good listen to the current market stuff, but you're kind of falling into the, what are your favorite picks? And that's great, but not unless you have these ironed out. And then putting it together into a portfolio. And then you get to the tactics. So really, what goes into the portfolio, not, hey, what do you like today? Okay. And the reason, before I turned on the recorder, people were asking me in the comment section of a lot of the articles. I'm constantly asked, well, what, you put a sell rating on that. Are you thinking about changing your mind or whatever? And it's like, ratings means so little to me, and I try to couch it, or explain it in every article that I write. There's so much more to it. But what underlies all this, from philosophy to process, to strategy, to portfolio, to the day-to-day, week-to-week, month-to-month tactic to use once this is all set. To me, anyway, risk management underlies all of it. Okay. It is what helps support. Think of this as a house, and this is the foundation of the house. So to me, it's a constant puzzle. Okay. And I'm going to rehash what I just did, but using words that are even more familiar. Okay. The why and the who. Okay. The why is, your philosophy. Why are you doing this? Before you can even have philosophy in a process, what are your real life objectives? This comes from my 27 years as a fiduciary advisor. Those who are not familiar, sold my practice 5 years ago, retired, and realized that I didn't want to retire. I want to come back and do this, just not have a direct client base. And I still work with the fellow who bought the practice. So, I'm still very much involved from a research and writing standpoint. So, the why, real life objectives, define success. What does winning look like? If you don't answer these questions, you're always going to be chasing your tail, which is ironic since I'm going to talk about the dog collar later. Must-haves and must-avoids. Like, to me, there's certain things I won't do. I won't hold a stock down 30, 40%. And I won't hold the stock as 20, 30% of my portfolio. Lots of people bragging right now, hey, NVIDIA is half my portfolio. Great. Good for them, not for me. Because if it was half your portfolio, it's probably a little less a couple weeks later. I'm a risk manager because more important than anything else to me is not going back and earning it all again. And I think a lot of people in the baby boomer generation with me are that way. Doesn't mean we can't try to make some good money, but it's got to start somewhere before you start really getting into this. A lot of people transitioning to becoming more involved in their investments after working, for a living, and these are things you have to contemplate. The Who, not Roger Daltrey, Peter Townsend, and gang, but this is the Who of your investment world. Do you want to do it yourself? Do you want to sort through the various experts? Okay. Or do you want to do what I would call a hybrid, which is a do-it-yourself and fiduciary split? I'm not telling anybody what to do. I used to have clients back in my advisory days that said, Rob, you and your crew, you're handling everything. Tell me when I need to know something. And there were other people like, hey, I'm comparing my own portfolio and I'm making more money than you are, which they probably were most of the time because they weren't managing risk. They were speculating, which was great. It's a nice little balance between the two. Now, I'm not in this business anymore, so, it really doesn't matter to me, but this is something that everybody has to go through. And again, this is something that, I probably should write a whole article or a blog for Seeking Alpha on this because it's constantly misinterpreted. So I figure, okay, for our group here, I want to make sure that it is understood. There's a difference between advice and research. I used to do advice, now I do research. And this is a definition I got, from online, but it was a good one. Okay. Matter of fact, I think it's from the SEC. If you disseminate general and impersonal information, that's not advisory. You're not being an advisor. Okay. But those who do need to be properly licensed. I was licensed for 27 years. I'm not licensed anymore. And the difference is what I'm doing and what I think for everyone to decide on their own versus somebody whose responsibility it is for your wealth. And I bring this up only because I have to assume with the large number of people I meet in the comment section on Seeking Alpha who misinterpret this and they think it's me telling everyone what to do. There's a lot of people out there on my side of it who are putting out, I cannot believe how often I say, this is the best stock. You should buy this stock. What do I know unless you tell me? And again, that's my old job. So I think it's very, very important. I like to summarize this as do it yourself means doing it yourself, but it doesn't mean doing it alone. And that's why, folks and services like what we do exists. Now, into the meat of it, I'll go pretty quickly through this. How do you solve that puzzle? Well, I have kind of divided it here between the what, the when, and the how. I promise simpler words. We got the why and the who. Now I got the others, right? Who, what, when, where, how. So they're all roughly equal, but the how is a little bit more important. So let me start with this, okay? What? What do you want to consider owning at a price? Meaning, I don't know if I'll just simply buy it now. I'd love to buy NVIDIA in the portfolio and collar it. I'm not going to do it right now. Don't love how it looks. Maybe there will be a better time, probably when a lot of people don't. And all the leverage is out of it. So owning it at a price, to me, the fundamental quantitative part is long-term, and that helps me create a watch list. And the watch list is I'll consider owning these. If it's not on the watch list, I might notice it, but unless I think enough of it to put it on the watch list, it's outside it's outside the room looking in. Okay, that's the what. Then we get to the when. The when is taking action, meaning I'm actually going to buy or sell something, and the fundamentals and the quant will be part of that, but to me, it's the technicals. Now, for other people, it may be all fundamental and quantitative. I'm a technician, and depending on the tickers you guys have asked about today, I will see if I can incorporate some of the stuff that's on my mind, which is I cannot believe how many stocks have absolutely cratered since I sold them. So you can decide how much is skill and how much is luck. But boy, I mean, I have a lot of stuff that I have sold in the past year that if I had held it for another 3 to 6 months, that'd probably be down 20% at least. And that's all the technicals bailing me out and helping me manage risk. That's why I use them. For a lot of people that are do-it-yourself investors, I think what they are finding in this service, like my previous subscribers and clients did before me, is that I speak this language pretty well. The market runs by this language a lot more. And so that makes me a pretty good asset for a lot of people. And then the how. Now, this is where, depending on the questions that we have and the tickers, if we have time, happy to go back to this. I'm sure we'll do plenty of sessions on subscribers and me. This has become a much bigger issue to me. Okay, these are always the same. Oh, you need a watch list, and you need a decision mechanism. What's going to make this list actionable? Okay, and we have something called a depth chart here, so which kind of ranks them, and I update that regularly. But the how to me is the single most important factor in the markets that we have today, especially with so much geopolitical uncertainty. And it is also extremely important, I think, for bottom line performance. But a lot of this requires education. I'm here to give it. So what are we asking? How? What does that mean? How? How do we want to get exposure? We said we want to own it at a price. We decided to take action. But now how? Well, what do you mean, Rob? If it's stock, you buy it. If it's an ETF, you buy it. Yeah, that's one way to do it. But I have used options, sometimes a lot, sometimes a little, sometimes not for periods of time. I happen to think that the development of the options market, along with the ETF market, has crowded out a lot of things I used to use stocks for. Not entirely, but more than in the past. And I actually think that not speculating with options, not trading options, although that certainly can be a part of it, but that's a different type of service than we're offering. I'm always happy to talk about what I'm doing in my trading accounts, but it is not formally part of the service. Options are a big advantage if you know how to use them, as I like to say, meat and potatoes style. Okay, and maybe we'll talk about that a bit today, because just based on some stuff I've been doing in the portfolio. And the last thing is options. Using those options as a surrogate. I actually did this today in the Sun Garden YARP portfolio, and I will explain what that means. Okay. And again, you've heard this before, risk management. Okay. To me, before I do anything, I want to know what success is going to look like, and I want to know what failure, if you want to use that word. I wouldn't call it failure if you do something that you believe is going to make you feel better about how you're investing, and you're trying to avoid major loss, even if it turns out that whatever you're selling didn't fall through the floor. And for those of you who are maybe not as familiar, this is kind of what it looks like when it's all done. A stock basket, an ETF basket, decent amount of cash these days for me, putting call options on the broad market, own a call, and we own a put. In other words, if the SP 500 goes up 10% like that from here, I have a way to make a lot of money without risking very much. Same thing if it goes down 10%, even 5. And that's what this is about. And obviously, we'll intersperse the option stuff. Probably going to be drilling down on it quite a bit with subscribers. You may have seen in the announcement we put out recently that we're going to do, I think this one and maybe one more, and then we'll have probably one a month, kind of a macro, short macro session once a month, and anybody can join that. But then we're gonna close the doors and make it subscribers only because we want to start to get into some real nitty gritty here. Okay. I'm going to leave it there with the dog collar, which we can always get to. And actually, I think I'll go back to this because it's the busy one. So first, before I get to any of the ticker chat here, does anybody have a question? Let's say that is, let's see, that is not a, let's say not a ticker question. In other words, any questions on what I just went over. Let's start with that because I want to make sure if there's any misunderstandings, misperceptions. Any questions on any of the slides I just went over here? All right, well, let's get to the questions. This first one is actually a really good one. Well, they're all good ones, but this one is one that gives me something to think about. Okay, hi Rob, just an email regarding a trade alert at 2:01 p.m. Yeah, I try to get them to him as early in the day as possible. You can only imagine a day like this. I usually explain to people that I mean, there's no trade that I would say goes stale within 24 hours. Most of them do not go stale within probably 48 to 72 hours, excluding weekends. So, and I think what I hope people are going to get out of the service as much as, more than anything is, what I'm doing, the style in which I'm doing it, and because it is ultimately a research service. But let's see, as a current subscriber, do you offer a way to get text alerts? Android, not iOS phone. I wish. But I do believe that Seeking Alpha has a they are not keen on us let's say like emailing everybody, etc. I think most of the stuff that we do is through the service itself. I may be wrong. That's a good Dana question, and I will ask her when I see her a little later. It would be great to send that type of thing out. The thing I could do that might be easier would be to use the chat, because the chat is probably, and again, I'm just going to write this down. Okay. I'm pretty sure we're not going to be able to do text, but we bet if I start putting this stuff in chat, I'd rather use the chat for everything anyway. It's so easy and it's so fluid, and I really appreciate anybody amongst the subscribers that's already using it. Okay, let's see. Can you walk through the let's see, is it the why, which let me see. Pick the stocks you bought today. What did you see in the charts? Great. I will be going over every one of those. Okay. And then somebody's asking about LHX. So I'll get to that one. Let's see. I got a, somebody just said yes. Okay. Is this a naked call talking about my purchase? And look, I mean, this is, I guess, a freebie for those who are not part of the service. I mean, as I see it, I could show you my portfolio today, and it won't mean anything because, there's enough turnover in there that the portfolio itself will get stale, especially with a lot of cash. So I'm happy to, kind of show, let's say all the trades we did today, because it's just one day out of many. Okay. The question is about my purchase of a gold ETF today, IAU. And let me see. Okay, I will explain that. All right, let's see. Emails for what type of result they are looking for. Let me see. I just want to make sure I'm going back. Okay, yes, if you can clarify the question, because I'm not quite sure on that one. Okay, would you consider art? I'll get to all these and start in a second. I'm just taking account of them to prioritize. Okay, would you consider ARTY, which is an AI stock ETF that I own in the core portfolio? If you're new to the service, the core portfolio is really what I ran for my clients back in the day. I didn't want to get rid of it, and I wanted to have it, and the fellow who bought the practice uses it. So, I mean, it's still, I guess, a decent amount of money invested in it. But it's an all ETF portfolio with that same kind of option thing where we have calls, well, buy call options, buy put options at times. Let me see here. Artie has a dog collar possibility considering is 12%. Okay, so Artie, the thing, okay, we are mixing things here. Let me get to that. I'll start pulling up the charts, so it'll be easier. And let's see, pertaining to my first question, let's see, would that be the first question up above? Trade alert, yeah, okay. Got it. Result, yeah. The bottom line on the email delivery is that I have to double check, but I'm pretty sure Seeking Alpha does not want, and it's one thing if somebody like DMs me and says, here, can you email me? But they tend to want to keep everything inside the platform. I don't know if that is because maybe in the past some people took advantage of it. I don't know, but we'll clarify because I'm doing this from long distance memory here. Okay. All right. Keep sending the stuff in, the questions. Let me walk through what I did today, and then I will look at the ones that people asked about. And in order to do that, let me go back and share this screen. Okay. So this is right from where I sent it. See, and we can go into the chat right here. All right. So trades I made today. I'm going to make this a little bit bigger. Okay. So we had 3 stocks left in the portfolio that were not collared. They were just owned by themselves. And I'm going to see if I can pull the chart up here, and I will show you why I did that with each one. Okay, SWKS, HD, and CVX. And let me also, and if you're not a Seeking Alpha subscriber, I mean, for what they charge, like $300 a year, and usually there's discounts. Wow. I mean, like to me, I would strongly encourage. I mean, I'm on this all day, and the amount of years I've spent in this industry, over 30 years, for me to say, hey, I'm on something all day, I can say that about Seeking Alpha, and I can say that about Y charts, and I can say that about my charting programs. That's it. Okay, so the issue with Skyworks, and again, this is how I think. Okay. It's in the portfolio for a lot of reasons, but if a company gets a high profitability rating, I do rely on these a lot because I'm a technician, not a fundamental analyst. Here's the issue for me. On Wednesday, after the market, they are coming out with earnings. And I really didn't start to use this until very recently, but This is becoming a pretty good guide, so much so that as soon as I have a little bit more analyst support, which is soon, I'm going to go back and start testing this. Okay. Seeking Alpha has a few different grades here. I rely on profitability. I like to look for things that are cheap through their valuation, but I don't trust any valuation right now. Growth matters less to me because I don't have to own something for years. It's always helpful, but momentum, I'm a technician, so I don't really need the momentum stuff. I think it tends to be Johnny come lately. But these earnings revisions, I'm starting to see, look, I'm a pattern recognition guy. So when I see something like last 90 days, 2 revisions upward, 19 revisions downward. I happen to think that the whole Wall Street analyst rating and earnings game is totally a game. Okay. It's a game of BS. But to the extent that it moves markets and moves stocks, have to respect it. I look at it as the chart's going to reflect all that anyway. So, but I'm seeing, you know, any bit of extra evidence, any edge I can get. So I sold this specifically because well, it broke down on me. This is kind of my steady support here. And I was good with this one until it bent over right here. That's the problem. And now this is going into negative. Those of you who've heard me talk about charting before, and I'm not sure what happened in the afternoon here. Let me just see. Yeah, I mean, the whole market faded a little bit in the afternoon, so it might have just been market driven, or it could have been tech stocks. I'm not sure. Do the post-mortem, you know, some other time. But this is, to me, a sign that, okay, something may be up here. It's already in a weekly downtrend, and now the daily is following too. So my hope when I originally bought this, I don't know, back in here somewhere, was that it would work its way toward the top of the range. This is not a bad collar candidate, but you know, I don't see any reason to stay with it. Okay. And what's going to happen on Wednesday night, or let's call it Thursday morning? This stock, because it's a tech stock, is probably going to be up or down 5%, if not 10 or 15. Depending on the market's mood, depending on what's going on with tech stocks. I want nothing to do with earnings. And one way to have nothing to do with earnings is I can still own something, but I'm going to own a put option underneath it because I want to define my worst case. That's what this is all about. Okay, so that's one. Let me zip through the others. Home Depot and CVX, okay? Look, I'm partial to the Dow stocks, okay? So I gave it a good hard look, said, okay, am I really going to sell these 2 Dow stocks? One of them is Home Depot, but my history with Home Depot goes back to right about here. A little bit lower, I think 326, somewhere in here. Okay, it's probably where I entered. Yeah, using the chart the whole way, and you know, my valuation, quantitative stuff along with it. Bought and sold it a few times across here, but that doesn't work as much anymore. Trying to play with the position sizes is a lot tougher than it was last year and the year before. And so instead, I'm looking at things and I'm saying, okay, if I'm not going to collar it, and I don't think earnings are for a while here, but if I'm going to collar it, I got to buy 100 shares at $400. So that's over $40,000 for a round lot to be able to have an option against it. And I mean, partly, I mean, look, yes, this is a chunk of my own money. But I've heard enough people say, you know, it's harder for us to do things if we're throwing $40,000 in a single stock, or even $20,000. So, you know, I'm running this I can buy whatever I want outside of the show portfolio. So I am keeping this as, you know what, I'm not going to be able to even consider this for a collar unless it gets cut in half. So if I'm not going to consider it for collar, I don't want to own anything outright. And if it fools me and goes to a new high level, fantastic. Good for it. I can always participate in one of a zillion other ways. Okay. Can buy a call option. I can buy an ETF that has a lot of Home Depot in it. I can collect up all the Dow stocks that I don't own that are higher weightings, and I can own DIA because that's, part of it. So, there's so many different ways that I can do it. And now to CVX. Well, CVX might be what Home Depot looks like, fairly soon. It's already starting to roll over. Most stocks are. And I looked at this, I probably looked at this one the hardest today. And I just decided, you know what, it's right in the middle of this range. Not to mention oil stocks almost trade as a group as much as anything in this market right now. So, why mess around? I have a very high bar for what I want to own right now. Otherwise, I can ETF it, I can use options, or I can collect, more than 1% a quarter, sitting on my proverbial behind, with cash and T-bills. Okay, so that's those three. I bought TLTW, which is it's TLT, but with covered calls on it, all inside an ETF. And I've got a lot of cash, want to get more yield, so I'll take a 5% position in something like that. I think that long rates are more chart wise, they're probably neutral to leaning lower rates, higher prices, which would help TLTW. But if rates go lower, I may have to. I try to say if rates go higher, I may have to revisit this fairly soon. But another issue for another day. Okay, let's see. I want to talk about this one first and then get back to the collars. So one way that, and this is the first time I've done this in the YARK portfolio, okay? I can probably count in the thousands in my career the number of times I bought a call option. Remember what I said about this being a surrogate, okay? So the surrogate, it's a surrogate for owning IAU. Now, what does that mean? Okay. So here, let's take a simple example. Let's just take one. Okay. If I want to own 100 shares of this, it will cost me $5,000. Okay. $5,300. All right. However, that's $5,300, and if gold drops, okay, and I don't do anything with it, for every 10% it falls, I've lost $530. So I'm gonna write that down. Okay, $5,300 is the investment. $530 would be the cost to me of a 10% decline. Well, what I did instead, and there's a million ways to get option prices, but I'll just show you this one because it's right here. And let me remember what the specifics were. I can't wait to teach you guys all the nuances of options that don't involve speaking Greek and using terms like butterflies and iron condors, which frankly, I can't even remember what those are. Meat and potatoes. So let's see. I bought April 55 calls to open, meaning I didn't own it before. Okay. If I sell it, it'll be calls to close. Again, lots of places you get option terminology and read about that, or I do a session on it. Okay. April 55 calls, 96 cents. So what happened in that same example? April calls, not puts, which means I make money if this goes up. Okay. And I guess it closed the day right around the same place. Okay. So let's call it, let's round up, let's call it $1. All right. So it cost me on this $53 stock, if you will, it's $53 ETF. It cost me $1 to basically be able to sell IAU at 55, okay, before, when was it? April. So this is what I like to do, or one thing I like to do, when I see that something is, yeah, gold started to move, okay, if I back this out a little bit more, get rid of this little circle here, okay, this is now the weekly chart, and my chart work, try to line these guys up, okay, I can project this going higher. This is not my table pounding strongest buy recommendation, but I see it. I see it breaking out above here, just using a lot of different aspects of the technicals, and this is a good pattern to me. It could have a little more run. More importantly, I think I'm going to find out very soon. In fact, when we get to the collars, you'll see there's a couple that I did that have earnings coming out this week. So here, the way it works is, so I spent $5,300, or I could have spent $5,300 to buy 100 shares. Well, instead, I spent $1,000, okay, I'm sorry, I spent $100, get the math right, okay, I spent $1 a share, or $100 to buy an option. And I have until, I think it's the 17th of April, for this to go not just to 55, which was my strike price, but up to 56. If it's at 56, what would a ticket, as I like to call it, okay, I have a ticket that says I can sell this thing anytime before April 17th for $55, but I paid $1 for it. So 56 is kind of my break even. So if it goes above 56, so I'm not counting on gold meandering up. I'm counting on people getting, hungry for gold, okay? If it drifts up to 57, then I will double my money. Okay, $100 becomes $200. But the point is, if gold goes the other way, if it goes to 48, if gold crashes, okay, to 43, 40, I can't lose more than $1 a share, $100 per option. So I didn't want to have $5,300 at risk, and I want to know quickly if I'm right. Now, the best thing that could happen is that gold just goes absolutely ballistic. Probably not the best example because it's easier to happen with stocks. But let's say gold goes up 20% in the next 2 months, and now it's sitting at 63. Well, I have a thing that says I can sell it at 55 plus $1 I paid. What would it be worth to me if gold goes to 63 by middle of April? Well, it'll be worth $7 because it's a 55 strike price. It cost me $1. So 56 is my break even. I would have a profit of $7 on top of that. 7 to 1. Okay. That's what I do. And look, if the market were a little more buoyant, like this is not my favorite thing to do, okay? But it's kind of like, all right, I've mentioned to subscribers, I've got cash burning a hole in my pocket. I wouldn't let that happen for too much longer. So I'm looking for stuff like this. Now, if I come to believe that gold's going to have a more sustained move, easy enough. I mean, I have two choices. The 100, if I can wait around, and if in the next 2 months or so gold goes to 56, 57, 58, I can exercise the call option and actually buy it for 55, or I could just sell the call option, buy it there anyway. I can buy IAU directly and start buying shares. I almost did that. I decided, nah, I'm going to try doing it this way, in part because I wanted everybody to see an example of that. Okay, that's that. Now we get to the option collars, and then we'll finish with the trades for today because it was a busy day. All right, so
Hey, Rob,
yes, sir.
question. You mentioned there 6% notional exposure. Can you explain that,
Oh,
please?
yes, thank you. Thank you. Yep, that was part of the question. Okay. So what I did, and you know what? It's better. Let me pull something up. It'll just be easier to do is like in a blank page here. Okay. So 6% notional exposure. Okay. That means basically, okay, put this down here. When we say notional exposure, we mean if it's not getting any bigger. Hold on. I see why. Oh, yeah, better. Okay. So yeah, I said 6% notional exposure. That's another way of saying, let's just keep it simple. Okay. So let's see. If I bought one contract, okay, one contract on a stock, an ETF that is $53 a share, one options contract equals 100 shares. So one option controls 100 shares, and that means this is $5,300. So for every contract I bought, what I'm saying is if I had instead bought 100 shares of IAU, and actually technically because my strike price is 55, okay? It's 55. All right. So this, if I had gone out and just bought 100 shares, because some people want to say, I don't want to mess with the options. I'm going to buy some number of shares. It could be 25, 50, 82, 1,000, whatever portfolio size is. But in this simple example, okay, if I buy one option that represents 100 shares, it has the same impact, except for the time involved, okay, as investing $5,500 in IAU. The difference is my maximum gain, unlimited. My only obligation is nothing. I mean, my only if IAU goes way up, I'll have something worth value. If it plunges, so what? Hopefully you're starting to see why, especially with the put options, doing this before earnings is what I like to do. It allows me to have the guts to go and own something when earnings are coming up, so I don't get blown out of the water. Okay. The max gain is unlimited. What's the max loss in this case? $100, because I said I purchased this for about $1 a share. Okay. That's the most I can lose. If I invest $5,500 and gold goes down 10%, I've lost $550. And frankly, this is also about lifestyle, right? I don't have to be watching this thing every day. It's gold. I mean, it can get freaky at times, get gold, oil, stocks. So to me, I'm willing to have the convenience of saying I can't lose more than $100 on this. Okay. Now, where does the notional exposure come in? Take that number and say, okay, if I had, and let's, I guess the round numbers, okay? If I did this in a $90,000 portfolio, like real dollars, okay? if my portfolio, for every $90,000 that's in my portfolio, I own something that only cost me $100, can't lose more than $100, could be worth more. But this is what percentage of this? About 6%. Okay. I'm skipping ahead of myself, but those of you who remember the macro tracks concept that I talked about quite a bit, especially back when we were on Substack, not Seeking Alpha. I look at it this way. If you take a chunk of money and you go and collect that T-bill, income, or you buy zero coupon bonds for a few years, you've locked in a minimum return. You could take another portion of that money. The quick example, very quick example, okay? Because this is one of the other ways I try to give people ideas on how to do this, okay? I have $100. I'm going to invest $90 in, I don't know, let's call it 2.5 year T-bills, 2.5 year treasury notes, okay? Well, I know my 90 is going to become 100 because I buy it, let's say zero coupon, and that 90 is going to be 100, even if I get the income. My 90 is going to become 100 if I don't take the income out and spend it. I started with $100. Well, I pretty much know I can't lose, right? I can now take the other $10 from my initial 100. And what can I do? I can be as aggressive as I want, and I can't lose. I can lose out to inflation. I don't know, maybe the US government won't be able to pay me in a couple of years. Not going there. So I look at it this way. Geez, I can invest in the S&P 500, but if I got a little part of my, and I do this with a couple of my, one small account, one not so small account. And all I do in here is I buy call options and I buy put options, because to me, over the next couple of years, I want to turn this into, I don't know, 30,000, 40,000, 50, I mean, for $30, $40, $50. Okay. If I turn this 90 into 100 and, 10 into 30, okay, I've made a 30% return, and I could not have lost more than 10, because as a matter of fact, I couldn't have lost anything. Okay. I'm going to end up with $100 as a worst case, because the 90 is going to become 100. Whatever I do with the other 10 ends up being my profit above 100. If I break even, I'm at 110 a couple of years later. I just want to go over that concept for anybody who hasn't seen it. To me, it is something that it's so simple. It's so meat and potatoes, along with the option stuff. And the reason most people, especially if they have advisors, the reason they don't hear this from them, the way I used to use this all the time for my clients, when I had clients, when I was licensed, I think the reason is because there probably isn't a lot of money in it. You can't charge a high fee on it. I mean, you just charge normal management fee, or you can't make commission on it, or you have to do the work, okay? And you have to take the risk that maybe you screwed something up because you don't really know options that well, or who wants to buy T-bills when you can just buy ETFs. I've heard a zillion excuses. I did a lot of consulting to my old industry after I retired, and I heard a lot of that stuff. And to me, it's like, wow, kind of do-it-yourselfer's best friend. But we couldn't do this for 15 years because rates were at zero. Well, now you can do it, with T-bill or other rates. And there's any number of possibilities of this. So that's another thing that starts to really look pretty good when we start to go with the option. Merck, Procter & Gamble, okay? I'm going to actually copy these just in case we need to pull them up again. So what I did here with Disney, these are 3 stocks that I'm concerned about the downside, but I'd love to grab the upside, and I'll show you why in the charts. All syncs up with the charts. So with Disney, little lighter position. I wouldn't go anywhere near Disney without getting a little bit more of a sort of price catalyst, but now I can, because let's keep that in mind here. I'm going to move this over, get rid of all this. Okay, and pull the chart back up. There we go. All right. Always a technological challenge. So here's Disney. Okay. That's let me get some of this out of here. That's not a gorgeous chart. It's an indecisive chart to me. However, you know what I'm looking? Okay. I am trying to look at this market as much longer term in nature. At the same time, this stock could go from here to here in a heartbeat next time earnings come out, which I think is soon. What I'm looking at is I'm looking further down the road and saying, okay, if I start a position in Disney now, and this kind of works itself out of this range, I've got a lot of upside. I mean, this is why I call it the dog collar. Disney's a dog right now, okay? Stock is at half of what it was in early 2021, okay? 4 years minus 45%. So I took the position, but I said, wait a minute, okay. If it goes below 105, and again, this is art and science, okay? I'm willing to give up, I'm willing to lose 6 points on this, more than that, 9 points on it, okay? And it cost me $6 to buy an option that would protect me down at 105. Again, Disney could come out with earnings, fraud, not that I'm expecting that, okay? But look, I mean, markets have a memory, okay? Can I say for sure that Disney won't find itself at $60 in a market crash? You know, I've lived through 2 of these this century. You know, S&P down more than 50%, NASDAQ down more than 80%. Well, I want the upside, but not at any cost. And I don't want to have to rethink this all the time. So 105 is as low as I want it to go. And 130 is where I'm going to have to cap myself in order to, just show you this again on here. Okay. All right. These are very similar in price. It's almost a wash. Actually brought in a little money. So basically, for every 100 shares of Disney I bought 1 put option that allows me to sell at 105, and 1 call option. I sold 1 call option, bring in the money now. If you don't own the stock, you could be forced to, sell a stock you don't own. So I would never ask anybody to do that. Okay. But the question was, why not just buy it and sell the calls? Yeah, you can do that all day long, and you can take in good money. Okay, you take in $6.55 a share, and all I have to do is get rid of the stock if it goes over 130 by December. Well, great. No reason somebody can't do that. I have no plans to do that, especially not in this case. There might be occasions where I do, but to me, if you take in $6 on Disney, and the next time there's news on Disney or the market falls apart and the stock's down to 90, congratulations. You made $6 on $114 stock, but you lost 4 times that in price. Oh, it's okay. It'll come back. Well, maybe, maybe. Okay. There's a lot of stocks that look like this. Okay. Disney is selling at the same price it was 10 years ago. All right. So that's why, to me, look, I'm a risk manager. Okay. I want the upside, and I'm going to work this position to the extent that it can be worked. But that's why everybody else just writes covered calls, and it works out great. And you're bringing all this income. unless the stock goes down and goes down quickly. And I think we're in an environment where you could see a lot of that. And you know, if you don't believe me, this is another one of the ones I did. Okay. Merck is starting to, you know, percolate down here. Okay. But there's a lot of people who probably sold covered calls on Merck and they just kept losing. Because if you bought the stock at 135 and now you're here, my guess is you did not bring in $35 in income in a year from this type of stock. Okay. To me, you're bringing in too many variables. That's really the bottom line for me. So let's see. In the case of Merck, 95 and 120. Okay. Well, you can see it in the chart. 95 is right down here. If it breaks down through there, we have bigger issues. So I'll let it slide to 95. Okay. In here. No, I think the last article I wrote on this was a few months ago for Seeking Alpha, and I had a sell rating. Doesn't matter what my rating is. I can collar it, and I don't care if it goes down 30 points because I'll get to sell it at 95. And I brought in 83 cents a share for every, so $83 for every one options contract or 100 shares that I bought. And I'm sorry, other way around. The puts were $2.60. So whatever. So $2.60 it cost me to make it so if this stock goes to 50, I can still sell it for 95. Good deal to me. And then in order to defray the cost, okay, won't do this all the time, but I'm doing it for now. I can't get more than 120 on the upside. So here, let me actually move these in. Okay, roughly. This is my range. This is my range. This is all I care about for Merck. If it goes below here, does not matter to me. If it goes above here, it matters to me because it's opportunity cost. But if the stock looks great and earnings aren't coming up to torpedo it, and the stock goes up to here, I'll buy more shares. Or, you know, I'll unwind this and do it again. I'm never worried about if I win. I'm always worried about what happens if I lose. And in this case, it was a pretty cool example because let me see. Actually, no, it was the Disney that was the example. Just go back to Disney for a sec, okay? Disney, my range was 105 and 130. So I can't do worse than this, and I can't do better than this. Well, let's put that in perspective, okay? My effective range for now on this stock until it expires, now in this case, Disney is December. So between now and December, I can't do worse than 105. I can't do more than 130. It cost me $6.12 to do this. And I offset that by receiving $6.55 per contract per 100 shares to lock this in. So effectively, this is what we call a zero cost collar. Technically a little bit in my favor, but whatever. Zero cost collar. So and ideally I'd love them all to be zero cost, but you usually don't get good enough price unless you go way out in time, you know, well over a year. But you can. Remember, I cut my teeth in the business doing this privately for people who had sold their business for, I don't know, 10, 20, $100 million. And they got stock of a company that they were no longer attached to in exchange for the one that they founded. And that's how I learned how to put collars in place for people. It was a strategy for people to do a lot of things with their stock. Still pretty popular, you know, in the brokerage world today. So I'm caught in this range, and if it gets up to here and it goes through, okay, I'll look at it again. And if it drops through here, fine. I could just take in the money, but then I'd have to worry about what would happen at Disney. All right, I went over Merck. The wrinkle with Merck is that the put options only go out to April. So come April, if the stock falls, well, I can still sell at 95. If come April, the stock is way up here, those options will expire worthless, but I've made all that money. But by April, if I don't want to be uncovered here, then I would have to buy another put option. I've got the call options on it, brought in a whopping 83 cents, caps me out at here, okay? And look, I mean, if I like Merck at the time it gets to, I guess it would be April, okay? The puts will drop off if the stock is not below 95, and the calls will still be in force until June, because I went out a little further with those to get a little bit more money, lower the cost of doing this. So again, bottom line, if you see Merck up around here in April, I'll have a choice. I can buy a put option, but now if I buy a put option, I'm doing it here and I'm locked in a gain. Now I'm not locking in a worst case loss. I'm locking in a gain because I bought it down here. Okay, that's the next part of this series. Okay, when you know, if and when we get to that point. So anyway, I want to make sure that that we get to the last one and see if there are any other questions. Yeah, everybody getting this? I mean, I'm going through a bunch of examples here, which are very timely in terms of what I just did in the portfolio. But okay, let's see. PG was the last one. Yeah, please just speak up if you if you wish. I know this gets heavy duty after a while. And that's which is why for subscribers, I'm about to put together kind of like a, I mean, and I've already had some help, thank you, with this, but I'm gonna try to put something together that's like very plainly worded to like here, put this in, plug this in. Yeah, I'm gonna try to figure out how we can engineer this a little bit. Okay. All right, let's see. PG. 165 to 190. Well, what did I see here? I see a stock that it's not one of my favorites, okay, but it's been in a long uptrend and it hasn't broken. So I can't say I trust the stock in a bad market, but in a bad market, this is one of the sectors, consumer staples, that probably can hang in there more than the others. So I decided, okay, let's add this one to the mix. 190. Can't even get up to 190 here. There we go. A little higher. Okay, good. Yeah, I wanted to get plenty upside with this one just in case it really goes. All right, so up there somewhere. So again, this is my range. Probably could have set it a little further down here because this thing could slip, but I was okay with the pricing I got. This is also not quite a zero cost collar. The puts were a little under $3, so it cost me under about $3 for this. It cost, I brought in $2 here, so it cost me $1 on $168 stock to have that range in place. And importantly, so it cost me $1. The range is, and I'll use this example. There we go. Okay. In the PG example here, it cost me $1 and 165 to 190. And let's see, where did the stock close at today? I think one was at 168, 169. Okay. Stock closed at 169. This is what I'm going to put into kind of like an easy table going forward, but I want to see what kind of questions we got first. So 169, 190 is my top, 165 If you've ever heard the expression caps and floors, I mean, it's probably what this relates to. All right, put these together. It cost me $1. So really that's, I'm going to net 164 if I'm forced to sell it at 165. And if I'm forced to sell it, I'm sorry, if I choose to sell it, if it goes to $100, I'm going to sell it for 165, but it cost me $1. So I'll net 164. So I can't lose more than $5. On the upside, I could be forced to sell it for 190, but it cost me $1. Well, last I checked, 20 to 5. And look, if I don't think they're achievable, I wouldn't do it. Okay. But I kind of like the idea that my upside is $20 a share and my downside is $5 a share. That is 4 to 1. And there's so many different combinations that you can do with this. I literally now own the URL collarstock.com because I'm actually thinking of starting a newsletter. I mean, whatever I do for subscribe, everything I do anywhere else, subscribers get for free. But I'm actually thinking of putting out like not so much an idea, but every day look at the market and say, hey, this is an interesting collar, and just put it out there. And eventually, might be a feeder into this service. So because I think that if the markets don't just keep, number go up, then I think that people are going to realize that you can take the risk out of taking a risk, and that's what this is all about. And I want to take more risk. Okay, let's see. All right, a couple more questions and we'll finish up. The problem with Artie, my friend Artie, because I'm from New York originally. All right, so Artie, let's see. The problem with Artie, even though I like Artie, all right, I'll stop. You could do it. The problem is if it trades options, they're probably very thinly traded. Doesn't even trade, or if it does, maybe it's every few months. Yeah, okay. Yeah, this is what we used to call back in my brokerage days. It trades by appointment. Okay, so there's not much to do. However, if you like Artie and well, what drives Artie? Usually when I buy an ETF, it's driven by a few stocks. Well, Broadcom, Arista, okay, this is, I mean, look, you could look at Broadcom, Nvidia, or you could look at, I don't know, could probably with a little bit of quick research, could find something that is, let's say, similar to this, but is a more popular ETF. This one has less than $1 billion in assets, which, is like chump change in the ETF world now. So, yeah, it's liquidity. That's the issue. You could do it. But if you wanted to do anything with that option position before expiration, you'd be hard pressed. You'd be hard pressed. You may not get the price you want. And so that's one of the nuances that hopefully, having somebody that's been around the block with this, can helps. Okay, so I did a naked call. Yes, naked call on IAU. Yes. Let's see. Okay, went through this, but I don't know if the message was entirely clear. So basically, I'm saying, look, I could have collared this, and maybe I will at some point, but for now, it was a very small position. I'm like, okay, I'm going to take a shot that gold really sprints higher here. If it goes up, over 55, okay, that option, or 56 with the dollar it cost me. So what is that? $2.80. So gold's got to rally probably 5% for me to break even. I'm taking a shot with that one. It's with a very small amount of money, and that's what I try to do. Okay, let's see. For more stable, won't drop real quick than any other stock like Disney. No, it's just I don't love gold. And so here, I'll give you an even better example of why I might buy call options. This is probably not the best example. Let me think. Oh, I don't know, let's say Intel. Okay. I'm guessing Intel's still pretty volatile and I don't like the chart, but let's say I did. Let's say I decided, you know what? Intel, I'm convinced that Intel's not going much below $20 anytime soon. I can go in and say, all right, let's see, between now and I don't know, April, 2 months out. I could buy the stock at 19 and change, or I could buy call options right at the money or close to the money here. And I can't lose more than $150 for every 100 shares. So, yeah, $150 on about 2,000. All right. My max loss. But if Intel goes crazy and goes to $30, I've made 6, 7 times my money. Or I can go a little further out and say, you know what? And again, now I'm getting into speculation, okay, which is not really the big part of the service, but just to show you how rangy and cagey you can be with this. Okay, Intel is that, or I do this sometimes kind of for play. Intel has I think Intel is going to make up for this lost ground. I mean, just hypothetically, okay. I think this could go to $30, you know, in a couple of months. Well, great. For 50 cents, $500 for every 100 shares, I get to buy Intel at 24. If Intel goes to 30, it's worth $60. I'm $6. Okay. It's 12 times my money. If I risk $1,000 and turn it into 12, okay. So again, options let you customize your reward and your risk. They really let you define your risk, and then you can get as much upside as you want. You may just have to do a little bit of extra work. Okay. Any other questions? Or we will break, because it's we always seem to go about an hour and a half because the questions are so good. Okay. Questions or just discussion, feedback. I mean, it helps me to know that I am going over stuff that is useful. Because starting in a couple of weeks for subscribers, we're really going to narrow it down, and it's going to be a little more like, okay, here's what's on my mind, questions. And it won't be as much of the, you know, this, because we'll have this on, we'll have it recorded. By the way, Sun Garden has a YouTube channel now. However you would find it, or we have a link, but yeah, we're on YouTube and we're putting these up every week, and you know, hopefully that makes it easier for people to say, hey, you know, I found this service, it's different from a lot of the others, especially with the rigor that we go through every Monday. And you know, if you want to kind of see what it's like on the inside, check out the YouTube channel. So all right, let me see. Oh, strong. I just saw this. Robert, strong sell. Wow. Okay. Were we talking about Merck? I don't know if we were talking about Merck or something else, but yeah, I've had a few sell ratings, but again, ratings mean absolutely nothing to me. Yeah, I would say still decent chance, like when Merck was here. When Merck was here, okay, I was like, oh, this thing looks like a basket case. And I had people write, oh, buying more every day, doubling down, tripling down, quadrupling down. Okay, whatever. I'm not telling somebody else what to do. I just look at charts. And when I see this spillover, it's probably going lower. Not 100%, but I'd say probably 80 to 90%. And now that it gets down here, I had told, and I was telling people when they read the article, I was like, you know what, around 100-ish, if it slows down, I'll get interested. But I'm still not interested because I could also see it breaking down here more because of the market, or because the industry is kind of under fire. We don't know what's going to happen next. Okay. But I'm seeing a little green shoot here. Maybe this tells me the momentum is stopping. Okay. I think I've covered everything. TLTW. Got it. TLTW. Did I say strong sell? Oh. I don't think it says strong sell. We just bought a 5% position in this in the portfolio, but it's hard to, these don't have the yields in them. So TLTW has actually done pretty well, and it follows TLT, which I think has a chance. Okay. All right. And look, we've got 7 stocks in the portfolio now. Seven collared stocks. Couple of those Yield Max ETFs on a couple of the Mag 7 stocks. Those are cases where I am not buying put options underneath. The stocks involved are Amazon, which, until it slows down, we're getting a lot of income through the Yield Max ETF. Looks stable. I'm willing to take, the risk on this one. Again, position size has everything to do with this. Okay. The other one is the one that is based on Google. Google also looks at least stable to me. Dipped a little bit today, but we'll see. And a good example would be Apple. Okay, I owned Apple. I didn't own Apple. I owned APLY. Sold it a little while back. I don't know, 6 weeks ago, something like that. 8 weeks ago. I said, okay, I mean, I don't know where Apple was, but it was probably up here. Okay, well, I guess the charts worked. Sold the Apply, I don't know, up in here somewhere. Stock went down. I really wasn't going to pay much attention to it. I was like, wow, Apple's down 15% that quickly. Okay, I'll go in. I'll buy it. I bought it at, I think, 222, and I collared it. 220 to 260, I believe, are the numbers. So once again, I'm always giving myself a 2-to-1, 3-to-1, 4-to-1, or better upside to downside. And as opposed to, let's say, having an ETF do it, a buffer ETF or something do it, or a covered call ETF where your whole downside is exposed, if you will. Why not in these markets? This will be an effective strategy until the market falls apart so much that volatility spikes, and then options either get too expensive, or it will still be good because you'll get better pricing because the options are so volatile. Anyway, okay, I've just about emptied the tank on. So, any update on Canadian research? Yes, it's been an ongoing thing. I got a list of about 150 of them. We're going to start writing one at a time. I hired a fella. I mean, part-time freelance type for now. But lots of experience writing about Canadian ETFs. I'm intrigued just in case the dollar crashes. I'll close with this. Okay, so he's got to get on board. Seeking Alpha doesn't let anybody write for them. Even as sort of a background writer or researcher, unless they vetted them, because it's too easy for people to not follow the protocol there, and that's one of the reasons I like Seeking Alpha. Anyway, so the dollar's had a nice run for a long time. Okay, as I say in the mob movies, it'd be a shame if something happened to it. All right, and if we see the dollar roll over, okay, and I don't see any immediate sign of that, but chances are to be news driven, not chart driven. And we've seen it get pretty spazzy over here. Okay, if that happens, well, I mean, anything you own in another currency could be interesting. So I may actually look myself into some of the Canadian stuff. Plus, it's a different type of market. So anyway, but we have some Canadian subscribers. And so I said, I'm going to try to start writing up some of the Canadian ETFs, maybe even Canadian stocks, and see if there's a niche out there. I would love to be the go-to Canadian investment person on Seeking Alpha. I don't know how many Canadian investors there are on Seeking Alpha, but I guess we're gonna find out. All right. This was brought to you by Canadian American Relations. Any other questions? Okay, and everybody else as tired as me? All right. Thank you all. We'll see you in the chat if you're a subscriber. If not, we welcome you to the group, and we'll see you next time.